So as Tommaso mentioned, I'm Jannah Patchay. I'm the founder of Markets Evolution and a director and policy lead for the Digital Pound Foundation. And if anyone wants to know more about that, then please find me afterwards. I'm joined today on this panel by Gabriel Bizama, who's the international policy lead at the Stellar Development Foundation, Patrick Hansen, Director of EU Strategy and Policy at Circle, and Jesse McWaters, SVP and Global Head of Regulatory Advocacy at Mastercard. And before this panel, a couple of us had some chats, and we are very mindful of the fact that this panel is coming after lunch and halfway through the afternoon, and that this can be a fairly dry subject. And we don't want it to be like that. So we would welcome audience participation. We want to make this as interactive as possible. I will stop at various points and ask for a show of hands if anyone has questions along the way. We're also going to not do something that I am very much guilty of on a frequent basis, which is turning this topic on the evolution of money into a navel-gazing philosophical examination of the nature of money and what it all means and things like that. We're going to focus on the practical applications and what CBDCs, stablecoins, and other new forms of digital money mean in practice, where they can be useful, and where they're advancing innovation in the various projects that everyone is involved in. So hope that sounds good. Also, as we've discussed before, please, don't wait until you're called on. Feel free to speak up. I think Jesse's in that mood anyway. So without further ado, let's start off with, I think let's take a step back. So who here, and again, you're a fairly, advanced audience. I assume all of you know what a stablecoin is. Who here is really clear on what central bank digital currency is? Okay, right. Who here would like to explain what a central bank digital currency is and how it differs from stablecoins?
I'm delighted to jump in on this one. I get asked all the time in my job about the coming class competition between stablecoins and CBDCs. And I think it's pretty much the most irritating question that I get asked, because stablecoins and CBDCs start from entirely different objectives, typically in terms of what they're trying to achieve, particularly when we think about stablecoins versus retail CBDCs. What's a stablecoin? I mean, yes, it's a link to fiat money, but more importantly, what do stablecoins get used for today? There are ambitions that in the future, stablecoins might be an important mechanism for P2P, P2M, and B2B payments. But the reality is today that the thing that stablecoins do best is they facilitate on-chain settlement for capital markets activity that's happening in the crypto world. This is just completely the opposite of what happens with CBDCs. The motivations behind CBDCs from jurisdiction to jurisdiction vary enormously. But the retail CBDC always starts from the point of view of how do we facilitate P2P and person-to-merchant payments, which is just an entirely different scope. And so I think it's really important when we think about these two assets that they can obviously exist alongside one another because they serve, at least for the moment, complementary aims. And even if over time they find themselves in competition vis-a-vis use cases, that's only natural and I think will ultimately be beneficial for both competition and innovation within the payment space.
So, Patrick, you're coming from a stablecoin issuer perspective. What kind of complementary role do you think that CBDCs and stablecoins have to play in this space, as Jesse was alluding to? And where do you think potentially stablecoins offer some advantages over CBDCs, aside from the fact that they exist at the moment, which is a key one?
Thanks once again for setting up this great conference. It's so cool to see the entire EU policy bubble crowd coming together once a year here. On the question, I would actually at least partially disagree with you, Jesse. We like controversial discussions, right? And I think what we've seen last year is clearly a decoupling from the crypto capital markets, how you called them, primarily centralized exchanges, speculative trading activity on the one hand, and then on the other hand, stablecoin settlement. We've seen the centralized trading market, I think, declined by 60 or 70% over the year. The stablecoin market cap actually went down only 10, 15%. So we see a clear decoupling from, just crypto trading and the use of stablecoins. And what we're actually seeing is that those instruments are more and more used for day-to-day payments, just peer-to-peer payments between individuals, for store of value use cases, just primarily for people in developing economies that face, high inflationary currencies. So I think by now it's safe to say, stablecoins have their unique use case. They are the killer use case as of now, I would say, of blockchains in general. And they're clearly not only used for crypto trading, but there's a broad variety of use cases that are powered by stablecoins. And I'm sure Gabriel will tell more about our cooperation with the UNHCR. Generally, just on the question real quick, I think the primary difference between stablecoins and CBDC for me as of today is that stablecoins are actually out there, operational, and they're settling 11 trillion in US dollars in 2022. CBDCs, on the other hand, it's hard for me to judge on at this point because it's just for now a project that hasn't been launched so far, and it's not 100% clear how the technical design and setup will look like in depth and in detail. So I agree with Jesse. I think there can be a lot of synergies at the end of the day. CBDCs could also be used to back, stable coins that then are used by the retail market in its wholesale form, for example. But I think it's a bit too early to tell, how that relationship will look like in detail, for example, in the euro area.
Thanks, Patrick. And as you've alluded, Gabriel has some excellent examples of use cases, and perhaps you can talk a little bit about that and your work at the Stellar Foundation and what you've been doing in collaboration with Circle.
Yes. First of all, I totally agree with Patrick here. I think that at the beginning, we have seen a lot of volume and basically transactions on the crypto trading side. But for example, Stellar is designed for payments. So as many of you know, actually the main use case right now is cross-border payments. So and there we have data. Part of my role is actually to collect data to understand what is the total cost of cross-border payments using digital currencies, for example, USDC. And basically the data, what it shows is that, for example, we have done a pilot for US Colombia, and the average cost of the market, according to the data of the World Bank, is 5.5%. And using digital currencies is 1.6%, or if there is no liquidity in the market, 2%. So actually there is something that is live, and actually in terms of affordability for migrants living in Colombia and sending back, in the US, sending back money to Colombia is a great use case that actually is happening right now. And I think it's not related to the crypto trading. Yeah, I would disagree partially with that.
And before we go back to Jesse for a robust defense of his views, tell us a little bit more about what specifically the use of a stablecoin in this particular use case enabled that would not have been possible using traditional financial and payments infrastructures and rails.
Yeah, I think that two main benefits. One is speed, and the other one is cost. I think that I have already touched on the cost. In terms of speed, actually one of the things, although central banks in the last few years they were working on real-time payment systems, most of the local payment systems are not real-time. So actually, you don't get the money actually immediately. So one of the things that actually maybe digital currencies and blockchain can provide is this real-time settlement, where actually you can get the money basically real-time. And on the cross-border side, that is relevant for, again, families of migrants receiving funds, but also in terms of merchant getting the funds immediately is something that actually digital currencies and blockchain can provide, that actually right now the system is not providing 100%.
Okay. And Jesse, coming back to you, Mastercard is a very much a traditional payments player. Well, I mean, Mastercard has, and others of its ilk have been responsible for a lot of innovation in this space, but this is a different type of innovation that you're seeing happening at the moment. And what are the opportunities that Mastercard sees in this space? And what are the areas for innovation that you see?
So I think I agree almost entirely with my colleagues on the panel here. There's obvious value to stablecoins. And while our analysis of the market suggests that to date, these sort of payment use cases remain relatively niche, we think there's clear value associated with them. And so we have explored, for example, on a test and a research basis, the opportunity to use, as you alluded to, Gabriel, the always-on capabilities of stablecoins to address areas where there is significant underlap in RTGS opening hours, particularly around evenings and weekends, that results in where we can use stablecoins to increase the speed of settlement and increase reduce the counterparty risk within those systems. We're exploring, for example, the use of stablecoins on our network to settle obligations between issuers and acquirers. And I think that we're also we've recently announced some really exciting work that we're doing around what we call the multi-token network, effectively an effort to drive increased harmonization through the creation of scheme-like standards and operational commitments between banks and VASPs within this space in a way that we believe can drive higher levels of compliance, interoperability, and consumer protection. But because I am a guy who spends a lot of my time thinking about regulation, I do have to take a moment to say that I think that those of us who spend a lot of time in the crypto space can sometimes become a little bit too focused on the role of technology in solving the problems that we have. I think it's obvious that real-time, always-on systems can considerably reduce the liquidity costs and the settlement risk associated with cross-border transactions. But that's only a piece of the significant costs that we see within the cross-border space. Regulatory heterogeneity creates a requirement for a lot of manual processing in this space. There's a need, for example, when complying with the tribal rule, when sort of working within the confines of AML and KYC requirements, when navigating different payment messaging standards, there can be significant complexity that there is a need for both organizational harmonization and regulatory harmonization on. And I think it's really critical to remember that we have to keep on working on that project alongside work on retrofitting technology. And in particular, when we think about emerging market use cases, stablecoins can be a great way of getting the money from one institution to another. But if the individual on the end of the system, the actual end recipient, still wants cash, what we know is that that adds considerable costs onto the remittance framework. And so we need to think not just about the technology that's getting the money from one country to another, but also the technology that's being deployed on a domestic basis to ensure that individuals can, as often as possible, be digital from end to end within that experience.
And I think you're touching there on some very important points, which I'd like to go into with everyone else in more detail, which are the barriers and challenges for adoption of these technologies or new forms of digital money, however you want to refer to them. But before we go there, I just want to ask the audience if everyone is clear from what the panelists have said on the benefits of CBDCs and stablecoins, or if there are any questions that people have at this point, feel free to ask. Yes, is there a microphone? Or you could shout. I think there's a microphone.
Hi. Hello. So I'm wondering, we talk about regulation, we talk about blockchain, digital assets, new technology. Do you see a problem in not what type of regulation we encounter, but also in the form of regulation, how it's published. I've recently had interactions with fintech organizations that were basically complaining about them not being able to cope with the complexity, with the very dynamic regulatory environment globally, often operating across many different jurisdictions. And they said they have a need for regulatory regulation and public policy that is coming in a format that is machine readable and actually easier to digest for their type of work that they do. Because right now, most stuff comes in PDFs. Some interesting jurisdictions also, they have like Word documents. It's like very hard to stay on top of regulation. Is this something that has ever concerned you guys? Has there been thinking around this?
I mean, this is a topic that that we're really interested in. We've made a number of investments into projects designed to facilitate sort of reg tech capabilities. But ultimately, I think as you correctly identified, there's a need for regulators to provide direction in machine readable frameworks. And I think that that's, I don't think that we should conclude that that is a solution to all of the problems. Regulatory heterogeneity that exists across countries would exist whether machine readable or otherwise. But I think we've seen some excellent work by entities, particularly the Bank of England, thinking about how they can move down that path. But I suspect it's something that we will see regulators do, as they do with all of their work, behave with sort of prudence and taking it one step at a time.
Okay, so
Yeah. Maybe real quick on that question. I think for us, it's less the form of the regulation that is challenging. I would say, as you mentioned, it's the different frameworks, regulatory frameworks that lay on top of each other. For example, in the Euro area, when it comes to stablecoins, as you know, stablecoins are e-money tokens, and therefore, at the same time, actually crypto assets, but also e-money. And therefore, they fall also under the e-money directive. And since, you know, as e-money, they are defined as funds according to the payment service directive. The payment service directive also applies next to AML regimes, etc., etc. So it's more, I would say, the breadth of regulations that might be challenging. And on an international scale, obviously, the question of how to reconcile those different pieces with one another on a global scale. Because as you know, stablecoins are by nature globally fungible. That's, you know, the main benefit that they provide for their users. They're like liquid, accessible, fungible, and interoperable around the world. And the question is, how can we build a regulatory framework around the world that, you know, allows for these main benefits to persist?
Thanks, Patrick. Any other questions on specifically at this point, maybe usage, use case, applications of stablecoins and CBDCs?
It's working out. I had a question about CBDCs and the use cases. I was wondering if the whole issue of financial stability isn't harming the use of CBDCs, because if we're looking at the digital euro, for instance, they're implementing limitations in terms of the maximum amount you can hold in CBDCs per person. And that also applies across multiple accounts, which means if you have 3 accounts, your maximum amount is divided between those 3 accounts. And it's also divided between the online, offline usage of CBDCs, which means if the cap is 3,000 euros and you divide that equally, it means that you can only have 500 euros maximum per account, online, offline, plus the 3 accounts. So isn't that like a real big limitation in terms of the use cases of CBDCs, defying the purpose of actually having, you know, something like that, just for the sake of financial stability and not causing bank runs or protecting the incumbent players, which are private banks?
I do have some thoughts on that, but I will let.
I think we're likely to see a back and forth play out on this. The current legislative proposal, as you correctly identify, suggests that individuals should be able to have multiple accounts. The earlier instantiations of the direction coming from the ECB suggested that there would be a single nominated PSP or credit institution that would maintain your account. This is relevant not only from the usability perspective, as you say, but it also has implications with respect to privacy and the need for data sharing across institutions and trying to meet the high privacy bar that the ECB has set for the institution, or for the concept of the digital euro. That said, and I don't want to be in the position of sort of defending the usability of the digital euro, because I think the current framework is something that we have a number of areas where we think it has the potential to create unintended consequences for competition and innovation in the payments space, particularly vis-a-vis the commercial model. But what I would say is that I think that if somebody from the ECB was here today, they might say that the waterfall mechanism, which allows individuals to top up and sort of move funds seamlessly to a commercial account, might address some of the usability issues that you've suggested, and that the limit would hopefully ensure the financial stability goals remain in place. But as you say, there's a lot of uncertainties here.
I think from the digital pound perspective, which is where I'm coming from, and the proposals for a digital pound retail CBDC in the UK, the limits have been proposed to be much higher. It's £10,000 to £20,000 for individual holdings, for example. But there is a principle behind it, which is preventing, as you've said, large-scale outflows from banks, and therefore impacting their ability to continue with credit creation and lending, and the potential impact for economic growth. Now, yes, given that CBDC is an unknown world, and it's unknown how people will react to it, or what their behavior might be, this seems like a sensible short to medium term measure to take. But in the long term, it also makes sense that, given that the constraints around stablecoins, for example, that they're not interest bearing, etc., that the design of a CBDC itself is not interest bearing, that banks are the only things that retain the ability to create interest bearing deposits. These things should be kind of opened up, and the market should be able to compete on its own merits, I think. I can see we've got a lot more questions about the digital euro, and do want to come back to that, but I also want to go back to our previous conversation about use cases, practical implementation, and kind of start to get more into what some of the practical barriers to adoption that in particular, Gabriel and Patrick, you're experiencing in some of the projects that you're involved with. So Gabriel, when you were rolling out the UNHCR solution, what were some of the practical challenges that you faced, and how did you overcome them?
Yeah, that is a really good question. Just for everyone to be aware of what is the UNHCR project. This involves actually the UN Refugees Agency actually using the blockchain, using USDC, using a digital wallet, and using MoneyGram for facilitating a cash out for disbursements of humanitarian aid in Ukraine for internal displaced persons. So this is live. This is not a prototype. This is not a pilot. Actually, we've been in a pilot phase in December 2022. Right now, the program is being scaled up. But I think that before getting into the challenges, I think that two main benefits that I just want to highlight. One is basically transparency. Using an open blockchain allows UNHCR to basically see where the funds are. And one thing that I just want to highlight, this is not basically transactional data that is linked to personal data, so privacy is protected. But from a donor's perspective, basically UNHCR having clarity on where the funds are, whether the funds are on a wallet, where the funds are at a MoneyGram location, that is really important. So that is one benefit. But from a user perspective, one of the main benefits is actually portability. So people, internally displaced persons in Ukraine, get USDC on a wallet, but if for any reasons they're moving to Poland, they're moving to Brussels, they're moving to any place they can get local currency through a MoneyGram agent. So that in terms of income protection, but also in terms of availability of the funds is something that UNHCR thought that was really helpful for using this solution. In terms of the challenges, I think we've been testing a lot. So we started with engagement with UNHCR in March of 2022, when actually the conflict in Ukraine, the invasion of Russia was started. And actually we launched the pilot in December 2022. So actually it's been 1 year of testing, making sure that the whole flow works, making sure that actually these are people in a vulnerable situation, getting funds. So we need to make sure that things work. So we test the whole flow in terms of getting the USDC on the wallet, making sure that you have a proper KYC. So actually KYC is being done on the wallet and also on MoneyGram, and also making sure that there is a high success rate in terms of the cash out in different locations. So basically people can go to a MoneyGram location and get the funds. So I think that the main challenge was basically making sure that people get the money, because again, these are internal displaced persons, they're refugees. So that is, I would say, the main challenge, and the results of the pilot were really positive. That's why, as I mentioned before, UNHCR is scaling up the program right now in Ukraine, and is also exploring actually expanding the program to other countries with other use cases, not conflict-related humanitarian aid. So basically, maybe SME development. So a migrant living in, for example, Argentina, running a business, not being able to go to the formal financial system to get lending. So UNHCR also provides cash transfers in these situations. Again, this is not conflict, this is not humanitarian aid, but I think that the program is shifting a little bit to more use cases and more countries.
Okay. Thank you for that. And Patrick, going to, onto what Circle does as an issuer, and as Gabriel's mentioned, that this project used USDC, and obviously Circle is most known for USDC, which is, as the name implies, USD denominated. Now you have a EuroC as well. And what are some of the challenges that you've experienced as a firm to adoption of that, and how can they be resolved and clarified so that you can have greater adoption not only of EuroC but other currencies as well in other jurisdictions?
Yeah, I think the challenges for EuroC, or we actually just rebranded, so it's EURC, are pretty similar to the challenges that USDC faces or crypto in general. I get asked that question every year, and the last couple of years I always used to answer it's like 3 main challenges that I see. It's like scalability, usability, and regulation. But I think we're making tremendous progress actually on all 3 fronts. I mean, on the scalability side, I think everyone's aware of just the plethora of layer 2 solutions popping up, of the various scalable low-cost blockchains that we're seeing being used today. So I think that's almost solved, or at least there is a clear path to solving that. On the usability side, I think that's the main barrier right now for the everyday user. Just the everyday user doesn't want to get involved with any kind of gas costs or recovery phrases and things like that. So I think we really have to build usability experiences that can compete with our beloved fintech apps like Revolut and others. And I think we're on the path to getting there. We at Circle, we just launched, for example, a product called Web3 Wallets, where we enable developers to build MPC-powered wallets, actually, that can abstract gas fees also away for the users of those developers. And for example, users that will use those MPC-powered wallets, they won't face any secret keys or anything like that. They can just log in through passwords or similar processes like we know today in Web 2. And so that is getting better as well. And the third pillar, the regulatory pillar, I think that's why we're all here. We're seeing tremendous progress in the EU with MiCA that already entered into force and will enter into application next year. There's a number of hurdles that we still have to take. We discussed that earlier. There is many specific technical standards and guidelines that still have to be issued and drafted by the European Banking Authority for stablecoins, and that will be challenging to implement also from a timeline perspective, because the deadline for stablecoins is already end of June next year. And some of these technical standards and guidelines will only be finalized actually next year. So there's really the need for strong practical cooperation on that front. So overall, I would say these are the major challenges. When it comes to Euro stablecoins specifically, I actually think that they will only pick up significant steam once we see those real-world use cases taking over, because the network effects of the US dollar denominated stablecoins in those crypto capital markets are pretty strong, and liquidity begets liquidity, and I don't see that fading away anytime soon. But when it comes to real-world use cases like payments, for example, in the EU, where European startups want to pay their employees in euros, obviously, I think that's where Euro stablecoins come into play. When it comes to the tokenization of capital markets, traditional stocks and bonds in Europe, through the DLT pilot regime or others, obviously we will need a Euro fiat cash leg settlement for these kind of use cases. And I think it's just a matter of time until Euro stablecoins will pick up steam through those real-world use cases.
Okay. I think we are going to get onto the digital euro in response to these questions that are coming in, but you touched on something interesting there, different roles for different things. And I wanted to ask Jesse, the theme of this conversation is CBDCs and stablecoins, but the universe of new forms of digital money is not limited to CBDCs and stablecoins. If we put crypto on a different spectrum, we've still got a range of different types of private issuances. We've seen a lot more discussion around and work being done by banks and initiatives like the Regulated Liabilities Network around tokenized deposits. How do you see all that work fitting into this ecosystem, and how do you see it coexisting in the future?
Well, I guess the perspective that Mastercard brings to all of this is that of a payment network, and a payment network particularly focused on facilitating retail payments. And what that means is that we're about creating secure and compliant connectivity between endpoints within a system. And we have today a network that primarily uses commercial bank money for those transactions in over 190 jurisdictions around the world, with thousands of different banks and fintechs connected into that system. And so it won't surprise you to know that we don't view the role of the network as being limited to simply commercial bank money. And that's why we're thinking about the role that stablecoins could play as a settlement network within the context of our network. It's why we've expanded into account-to-account payments and run real-time payment systems in over a dozen areas around the world. And it's why we're actively involved with institutions like the Regulated Liability Network, for example, in their partnership with the New York Federal Reserve's innovation pilot, thinking about the role that tokenized deposits can play within the role of financial services, or within the world of financial services. And I think that there is a temptation on blogs and on panels like this one to try and stick to sort of pit those stores of value in against one another. Apologies. And I think that's kind of silly, right? Like, if we think about account-based money today, we live in a world where there is central bank money, M0, where there's commercial bank money, and where there is e-money. Each one providing unique competencies and capabilities and creating value in distinct ways. If tokens and tokenized systems have value as a next generation for the transmission of value, then it's obvious to me that those rails are going to carry central bank money in the form of CBDCs, both wholesale and retail. They're going to carry commercial bank money, and they're going to carry stable coins, whether those be sort of bank-backed or e-money instruments. Rails can carry many different types of value. They can meet a wide variety of use cases. And so I think we need to think about how we bring all of that together in the most secure and interoperable fashion, rather than trying to pit them against one another.
Okay. And on to the digital euro then. So we've got a very broad question here, which is, can the panel give their view or views on the current digital euro proposal? I'm going to start with, actually, is the digital euro actually a central bank digital currency in your view?
I can start with that. I think that on the one hand, we need to differentiate what is retail CBDC and what is wholesale CBDC. I think that the digital euro is a retail CBDC, so actually it's money issued by the central bank, is digital public money. So I think that the answer is yes. I think that one of the things that actually needs to be a little bit more clear is what are the use cases for a digital euro. And that is also is a long journey. It's a complex project. So actually, I think that in the next couple of months, I would hopefully say we will have more clarity on actually what are the motivations and what are the use cases for the digital euro. In my view, for example, what we have discussed before, basically reducing the cost of merchant acceptance is one of the potential motivations from a policy perspective, that why you need a digital euro or any kind of digital currency. That could be also stablecoin or even like tokenization of deposits. So that could be one motivation. And then also settlement, making sure that actually you can get merchants can get money immediately, and they are not waiting, as Jesse mentioned, during weekends. They are not getting the funds. So that is something that actually a digital euro can provide from a retail perspective.
Okay. Jesse, your face doing some interesting things. So would you like to?
I mean, I disagree
vocalize
with
that-
Gabriel
okay.
on this. I think the intention of the digital euro is perfectly clear. I think that Fabio Panetta has given an umpteen number of speeches on this. I think that a wide variety of Euro policymakers have. And it's clear to me, based on the reading of those speeches, that the appetite of Euro policymakers is to provide a mechanism for residents of the Euro system to facilitate both person-to-person and person-to-merchant payments via in central bank money. And that the reason that they want to do this is, manyfold, but two primarily. One, to preserve the role of M0 in a world where physical cash is declining in terms of its level of usage. And two, to facilitate the goal of digital sovereignty of the European Union, to effectively have a greater proportion of pan-European payments settled by an institution that is domiciled within the European Union. And what I would say is that I think that that's quite different from cost of acceptance. The current legislative proposal specifically says that the cost of acceptance should be approximately the same, slightly less than the sort of comparable means of payment. And I don't think it's necessarily really about merchant settlement. I don't think anything's really been made clear yet about the relationship between the PSP or the credit institution playing the acquiring role here and passing it on. From Mastercard's perspective, we have actively engaged in the testing and learning around the development of CBDCs in a number of different jurisdictions, including the Bahamas, Australia, Hong Kong, and a number of other areas. And our view on this is that jurisdictions absolutely have the right to pursue whatever course of payment modernization they feel best serves the interests of that country. We're actively seeking ways that we can play a constructive and useful role in facilitating the digital euro. But at the same time, as I alluded to earlier, we have concerns about the current legislative proposal, which we believe could have some problematic distortionary effects, particularly vis-a-vis commercial markets, effectively establishing an unlevel playing field between private sector payment providers, ourselves included, but also domestic schemes and a variety of fintechs, and a government provider that fundamentally isn't bound by the same restrictions, and that could ultimately have implications for competition and innovation that I think are considerably negative.
Okay. Thank you. And I'm mindful of time and that we're almost out of it. Patrick,
Yeah.
I want to pick up in particular on something you said earlier about you seeing the utility for a wholesale digital euro in terms of being a settlement mechanism for stablecoins and other things as well. But what utility do you see in a retail digital euro, and what are your views on that?
Will depend on how it looks like. I think I very much align with my German compatriots on that question that answered in large amounts to the ECB consultation on the digital euro a few years back that highlighted the need for privacy, as a key value that could be served by the central bank. I think one thing that I wanted to add to the discussion, because I might slightly disagree here with the others, is that we're at the Blockchain for Europe Summit. And I think one thing that is clear by now, looking at the proposal from the EU Commission, is that the digital euro won't be issued on public blockchains. And I think rightly so. I don't think anyone wants the ECB to become a technology player that has to handle the technology risk, the governance risk, the operational risk that goes along with, issuing these tokens directly on public blockchains. And I think what we will see, and I mentioned it earlier, is that there will be forms of digital central bank money, but that the representation that then lives and is used on public blockchains like Ethereum and others, that will be provided by private actors, be it banks, be it e-money institutions and others. And I think we're already going down that way. The review of the Payment Service Directive, for example, is opening up central bank accounts for e-money institutions and other payment service providers next year. So that is going to be a huge step towards that goal of having, the safest form of money parked with the central bank and a digital representation of that, flowing freely on public blockchains, provided by public actors in an open private competition based on a rules-based regulatory framework provided by the institution. I think that's the end goal, and I think that's where central banks and private players can complement each other.
I know we're at time, but I just want to say I could not agree with you more. And that's why the recent collaboration that we did with the Reserve Bank of Australia is focused on exactly that use case. How do you take a retail CBDC, lock it, wrap it, put it on Ethereum, have restrictions placed on that token in terms of sort of what types of actors it can flow to, do a DVP swap for an NFT, and then have the merchant change that back out into Aussie dollars. And so I couldn't agree more that I think that's absolutely the type of public-private collaboration that we see on the horizon.